I'm not crazy about the idea of indexes from an innovation point of view. It's kind of an oxymoron. Stocks and indexes are there because of their past success, and disruptive innovation is likely to disrupt the traditional world order. So I think that the heavily indexed or benchmark sensitive approach to investing is ripe for change. And I think that the retail investor, the individual investor, is actually leading the charge.
In one of the most interesting exchanges of the year, Cathie Wood and Elon Musk went back and forth discussing the unbelievable nature of today's stock market. Elon, who has historically been a relatively anti-Buffett guy, challenged Cathie when he asked her about the Buffett indicator flashing red, and if she's worried about the state of the market considering this fact. In today's video, we break down just how important this little exchange is and find out how out of whack this market really is. So before we get started, I need you to understand what the Buffett indicator is. It's actually relatively simple. It's a measure that compares the stock market capitalization, or the total value of all publicly traded stocks in a market, to a country's GDP. So for the US, we would take the stock market cap and divide it by the gross domestic product, multiply that number by 100 and get this figure. This ratio has historically been used to determine whether an overall market is undervalued or overvalued compared to a historical average. In essence, if your GDP or your country's production levels are rising and your stock market rises with that number, that signals a healthy ratio warranting higher stock prices. When the stock market cap rises but GDP doesn't go with it, the ratio will jump up, causing what they call an overvalued signal. Right now, the US stock market is breaking records. The Buffett indicator is the highest it's ever been in recorded history. As of March 31st, 2021, it stands at 226%, 2 standard deviations above the historic trend line. To make the context of our current position more clear, we can draw regression lines and remap the data as the percentage above or below the historical average. Generally speaking, about 70% of the time, the Buffett indicator should be within 1 standard deviation from the average, and 98% of the time, 2 standard deviations from the average. As you can see, right now, we're about 2 standard deviations above the average. Either the Buffett indicator is broken, we're getting incredibly lucky, or a crash is imminent. This intrigued Elon so much that he went out and tweeted at Cathie to ask her about it. Here is the original tweet. What do you think of the unusually high ratio of S&P market cap to GDP? Cathie answers with a long thread, the first tweet being the most important. GDP statistics evolved during the industrial age and do not seem to be keeping up with the digital age. Thanks to productivity, real GDP growth probably is higher and inflation lower than reported, suggesting that the quality of earnings has increased significantly. So what the hell does this mean? Real GDP? Well, basically, Cathie is saying that regular GDP, officially known as nominal GDP, is measured without adjusting for inflation. Therefore, this ratio is not telling the true story. She believes that if you extract the real GDP, adjusted for inflation, and take into account the way we create value with new digital technologies, the official GDP figure would be a lot higher, making the ratio seem much more reasonable. She's essentially dismissing the stat as outdated, unable to keep up with the new financial world. Then she goes on to explain that technologically enabled innovation evolving today is dwarfing that during any other period in history. It is creating good deflation and explosive demand. Battery technology is a good example. Her thoughts here are controversial, to say the least. Cathie is claiming that due to rapid technological advances, we're actually seeing massive deflation and over-reported inflation in official figures, making the Buffett indicator somewhat inaccurate and actually representing the truth about the market. This may come as a slap in the face to people who are now paying almost 20% more for houses than they did last year. Inflation, no matter how much the Fed tries to deny it, is occurring all around us. We're seeing spikes in lumber, the stock market, houses, food, and various other commodities. Whether it's here to stay or just temporary, time will tell. But Cathie Wood thinks the experts have it all wrong. You can hear her elaborate on the subject in this clip.
We think there are major deflationary forces evolving in the global economy now, and they're fighting this notion that all of this monetary policy ease throughout the world is going to ignite inflation. Well, we believe that point of view is going to be in a dueling match with the two deflationary forces. One is good deflation and one is bad deflation. So the good deflation has to do with technologically enabled innovation. It is deflationary by nature. It rides down cost curves, gains efficiency, gains productivity. As we've told you before, in the electric vehicle space, for example, that deflation rate is 28% for every cumulative doubling in the number of units produced. So two forces of deflation. And then we have this question about money and how will it cause inflation. I don't know. I would say these two deflationary forces are pretty powerful in the short term. They're going to cause a lot of confusion. And you've heard me use the word velocity before. I know it's somewhat esoteric. All it means is the rate at which money turns over. If there's a lot of confusion, especially in the traditional world order, the velocity of money will continue to fall. The reason that the monetary easing globally during the '08 and '09 meltdown and afterwards, the reason it never ignited inflation was this velocity. The money went up, but the rate at which it turned over per year in the economy slowed down as people held back. They were risk averse, concerned about their futures, concerned about their company's futures. I think that probably will continue as these dueling deflationary forces, good and bad, duel with one, not duel with one another, actually are on the right side or the same side and against all of the monetary ease.
I would love for you guys to comment what you think about her opinion. Is inflation not as high as the Fed thinks, and is this why the Buffett indicator is broken? Tell me if things have gotten more expensive in your area since last year. Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed.